All right, guys, what's up? So I will call this tips for an easier $1,000 day, not an easy $1,000 day, because getting $1,000 is not easy, but tips for an easier $1,000 day. All right. So this is also going to vary based on the time that you get on in the day. You need to know the market's range for the particular time that you're trading in the day. If you're in during lunchtime, know that lunch is going to be a little bit slower, so you're going to have to get a maximized move. Now, as you guys can see here, from 9 o'clock in the morning until 10:45 in the morning, amazing time to be in the market. Very volatile, very high quality, very high volume, right? After that, 11 o'clock, it can be really good or it can taper off. It just depends on how far the market's going. So the market ran about $250 and then it retreated about $250 right back to the support line right here where all the consolidation was. From 5:30 in the morning until 9 in the morning, we consolidated. When you get 3.5 hours of consolidation and it's trending, so that's the key. The key is that the consolidation started on a pullback and it started trending up. When you get 3.5 hours of consolidation, you're going to get a pop. The market cannot just consolidate and consolidate and consolidate and consolidate and not pop off. So we popped off. We created the high that we were supposed to create in the first place, which is $23,112. Immediately, the reality is that it's not 112, it's 110. Okay, so they manipulated the extra couple dollars. After that, it rejected super hard to 92, right? So now you know that 23,092 is the level. So you go in here, you click boop, blue line. That's absolute level, right? On the 4-hour time frame, it's 85.50. So now we got this box right here is what we're going off of. The next level to hit to have a strong reaction, which we did again today as well, is this level right here. So I had drawn that up and I took my trade off of that, took a quick little scalp, and then we pulled all the way back to the 15-minute 200 EMA. And that's kind of where we've been as far as the lowest point is today. And then that's when you start to say to yourself, okay, how out of this do I reach my $1,000 day? Give me 1 second. Okay. Your tool matters. All right. So if you're working on micros, don't worry about this right now. Count this as a $100 day or a $200 day. But the tools that you're using matters. I'm going to pull up micros on this screen over here on the right. And I'm going to pull up minis on this screen over the left. Okay. On the left hand side. So let's say we're watching the 15-minute 200 EMA. All of this pulling back is happening. It's going and it's going and it's going. We're like, dang, where's it going to stop? And I'm like, probably the bottom of the consolidating point. Let's go and look for the 200 EMA. So the 200 EMA is right here. Let's set our trade at the bottom of those candles, right? Boom, one contract. We're gonna go one, it says 10, we're gonna go one contract. And we're trying to ride to $1,000 to start. So immediately you're gonna type in 200 ticks. So 200 ticks says that you need to get this far, right? So what's your risk gonna be? Let's say 60 ticks, which is $300. So 1/3 of the overall. I mean, you can go as high as 100 ticks, which is 500, but let's say 1/3 of the overall move basically is what we're looking for. So now, when you get down to the 15-minute 200 EMA, you get more than $1,000 in that follow-up candle. But guess what? The candle prior to that is about 915. When you get to the 2,000, the 200 tick mark, and you have $1,000, it's right there. So now it's going up. You surpass this candle here and you're like, I think I can get a little bit more. So in that case, you need to immediately lock in $300. You need to lock in your stop loss. Once you've locked in your stop loss, whatever happens in the stock market is just gravy on top. Now notice something about locking in your stop loss on a good trade. You waited for it to come down to the 200 EMA. It took it off the 200 EMA. It activated your trade. Zoom in a little bit so you can see that it did in fact activate. So it activates your trade. It takes off, right? We get up here. All of this trading happens, and guess what? It never comes back to your 200 EMA. It never comes back that 60 ticks. Now, sometimes we will retest, like these two here that we're retesting to reach the 200 EMA. It is different for these. than it is for this one. Once you get into this one and this becomes a full blue candle, you're good. You're golden. Now, if you can ride this candle up for 15 minutes, be done with your $1,000, and it actually made it all the way up to $1,395. And then at the end of the market today, right now, it's at $2,000. So if you can wait out all this, which I will never be able to wait out all that, I don't care how patient I practice being. That's just not what I like. I'd rather get my 1,000 and get on, right? So then let's say you're at 300 locked in, and it's right here. It's at $500. Now you have a decision to make. You've surpassed this candle here. You are waiting for it to get up to this candle wick. Anywhere within this candle to this candle wick is a lock. Why? Because of previous resistance right here, right? Give me 1 second. Okay, sorry about that. I had a phone call. So, like, all right, when the candle turns blue right here, right? Once you surpass this gap here, the body of this candle, and you're looking to retrace this candle wick, all of these resistance areas are going to react. So you can be patient for the full 15 minutes, because what you're looking for after you surpass the body of this candle is the body of this candle. And notice, yes, we did go higher, but we pulled back to the body of this candle. So this is about as far as I would normally be looking to go, which is another $160 to $165, right? On top of your $1,000 day. But you already got your $1,000 day. You set your trade up at the 200 EMA, and then you just wait it, right? Why is the 200 EMA so strong for the 15 minute? Well, because when you look at the 1 hour's 200 EMA, it's way down here. So in order for us to, on a day where we're ripping up like that and we're pulling back, we're just looking to go to support. We're not looking to come down to the 200 EMA. If that is the case, instead of stopping at the 15 minutes, we'll violate and we'll come down to this here, and that'll let us know that the market is drawing towards this 200 EMA. But the 200 EMA does act as a magnet, so majority of the time you're going to react upside and downside to the 15 minutes 200 EMA, right? So that's a great stopping point, or a great entry point. So now, stuff like this is the rest of the afternoon. After you do the run up, you know the rest of the day is going to be a lot slower. So that's a way to target your 300. So let's go back over the rules. Step 1, find the liquidity. The liquidity is where all of this consolidation is. So now we're going to go down there and we're going to get to the bottom of that liquidity, which is right here. And we're going to set our 1 contract trade up. Single contract mini, single contract micro. That's 300. That's $100 with a mini. It's $100, $1,000 with a. I'm sorry. It's $100 with a micro. It's $1,000 with a mini. 60 ticks minimum. 100 ticks is even better. That gives you all of this down here. I just don't like risking that much personally, but it's a 2-to-1 trade and it's still a good trade overall. But when you're doing an eval, you want to keep it to about $250 to $300. So $300 is the greatest point, because once you get below this line here and this candle, you've been invalidated. Your trade is no longer validated anyway. So you're moving on to that next hour and you'll just eat the loss. And that's something that you have to get comfortable with. If you're trying to make $1,000 in the stock market or $100 in the stock market, get comfortable with eating a loss to position yourself better for your next trade. So now going to the downside, all right, same thing. Go to the 5-minute time frame so we can see it even more clear. You see this form on the 5-minute time frame where you pull it up, you had a candle wick, pull it all the way back. When you hit right here on the next candle, they're giving you an opportunity to get back into the downside, because we're still looking. When this happens, when you have these massive candles, we need to fill that wick. So we're still looking to fill that wick with the body of a candle. Comes there, pulls all the way back, but your entry is here, so you're good. So let's say you're getting your 1 contract right there, and then look again, because it's important. Right here at 12:55, right at 12:55 before 1 o'clock, you get another opportunity to take this exact same trade right there. Guess what? That's worth about $890, $900. Get all the way down here to the $1,000 mark. And that's a key, guys. You don't have to go straight to $1,000. You just need to lock in your stop loss. So boom, we're going, we break down, we're pulling back or whatever. We get to this point. Let's say we lock in our stop loss on that first trade. Our stop loss is at $300. So of course the next candle wick will get you out of that trade. And that's perfectly okay, because before it went down there and it pushed back up, it came all the way down to about $1,000 exactly. So then it get there, and this is where you got to be like, don't be silly and be like, well, I'll wait for it to go past it or whatever. Once you get the $500, you should be locked in. Once Once you get to 750, you should be locked in. Once you get to 1,000, you should either be closed out or moving your stop loss down here. You know, because that's the next area. The blue line right there, the 200 EMA is the next area that you're looking to hit or whatever, right? And that's on the 5 minute. But notice the 5 minutes 200 EMA, once invalidated, is going to the next one, which is the 15 minute. And that's just a quick understanding of the range that you have to work with for $1,000. But your key, your goal to making $1,000 a day is not trying to reach the $1,000. It's locking in whatever your stop loss is. So if your stop loss is $300, if it's $500, before you can move forward with the rest of that trade, you need to be locking in, I'd say every $250, to be honest. $300 is a safe point because $300 is 50 more than the 250, and that's a third of the trade. Then you go into your next trade, right? Most people trade 2 to 3 times a day. So if you're trading 2 to 3 times a day and you're making $300 a trade, you're gonna hit $1,000. You're gonna hit $900 to be exact, but then you can get that extra $50 here and $100 there to get to the $1,000 point. But there are many, many, many instances where you can get $1,000 on the day. Just look at the range of the overall market to downside. Just look at the range of the overall market. We hit it here. Next candle was short. Guess what? The blue candle hit it. The next blue candle almost hit it. No, the next blue candle just missed it. They got about 890. The next red candle just missed it. They got about 890. This got about $600. This got about $500. This one, if you do the entire thing from there for the 45 minutes, sure, you get the $1,000, but you already know how that works out for us for the most part. That's not what we're looking at. But that's just a little idea of, you know, how to work towards your $1,000. $1,000 is your take profit. It's not necessarily the goal. The $1,000 day comes about by making good trades, good entries, and finding the range and being patient. Now, of course, if you're like me and you do the 9 o'clock in the morning, you guys already know how we get down. We find the low of the day, or we find the liquidity, which is all this stuff right here, and we take liquidity on up.